Welcome to the Deep Dive. This is where we help you get genuinely well-informed. We sift through stacks of vital sources, cut through the noise, and pull out those essential nuggets you really need.
To truly understand what's happening behind the headlines.
Exactly. And today, we're diving into the, well, let's call them fascinating and contradictory waters of the August 6th, 2025 market review. Now, if you just glanced at the headlines yesterday, you might have felt, a sense of calm. Maybe even relief.
Right. U.S. equity markets did close with headline gains.
Yeah, they actually managed to claw back some of those sharp losses from the week before.
The S&P 500 was up 0.7%.
Dow Jones Industrial Average, it nudged up 0.2%.
And the Nasdaq led the way, pretty solid 1.2% jump.
But here's the critical question, and our sources are screaming this. What if that positive finish is, well, deeply misleading?
What if the top-line numbers just don't tell the whole story?
And what if they're masking some really significant undercurrents you need to know about?
Precisely. So our mission today is to cut through that surface level stuff, our stack of analyses, reports, company insights. They're all pointing to yesterday being a session of profound bifurcation.
Bifurcation.
Yeah, it just means a split. This wasn't some unified rally, a rising tide lifting all boats. Not at all.
So more like a conflict.
A stark conflict, almost violent in market terms. On one hand, you had really robust corporate earnings pulling things up.
Okay, the good news.
Right. But on the other hand, you had these potent, frankly escalating geopolitical tensions, plus significant new U.S. trade policy shifts creating immense downward pressure.
Wow. So understanding that deep split is key.
It's crucial to grasping the true state of the market. And that's what this deep dive is all about today.
And that is exactly why you're here with us. This isn't about just memorizing closing numbers or getting a quick news blast.
No, we go deeper.
It's about understanding those crucial underlying currents, getting that insight that really explains what's going on beneath the surface.
Equipping you, really.
Yeah, arming you with actionable insights so you can be genuinely well-informed in a world that just drowns us in information overload.
Okay, let's get into it.
Let's navigate these cross-currents and geopolitical headwinds together.
The deceptive calm unpacking yesterday's market close.
Okay, so let's unpack this apparent calm. On the face of it, August 6th looked, well, decent for U.S. stocks.
The numbers seemed okay at first glance.
S&P 500 closed at 6,345.06. That's up 0.7%.
The Dow added about 81 points, ending at 44,193.10, a 0.2% gain.
And the Nasdaq, like we said, led the charge, up 1.2% to 21,169.42.
Pretty clear gains there.
Well, here's a wrinkle. It's worth noting a few data sources actually reported conflicting figures. Some even showed negative closes for the day.
Really? That close?
Yeah, it tells you how much of a knife edge the market was on. But the figures we're using, these positive closes, they're the most corroborated ones from multiple major news agencies.
Okay, so we can rely on those as the consensus. Technically up?
Technically up.
But here's what's truly fascinating, and our sources really hammer this home. While those headline numbers look positive, the rally itself was, and this is the key phrase, remarkably narrow.
Narrow,
meaning an outsized portion, and I mean disproportionately large. The S&P 500's entire gain for the day was almost entirely down to just one single stock.
One stock. Which one?
Apple. Apple Inc. Boost came right after the White House announced Apple's plan to pour another $100 billion into U.S. manufacturing.
Wow. So one company's huge news basically pulled up the whole index.
Pretty much. Think about the scale of that. One company's positive news, even massive news like that, had such a disproportionate impact, it essentially masked what was happening with hundreds of other companies in the index.
That seems problematic.
Well, the implications of a rally that narrow are profound for any investor, right? While mega caps like Apple might have soared, many other sectors, lots of individual stocks, they faced substantial selling pressure during the day.
So it wasn't broad strength at all.
Not even close. It points to a significant deterioration in what we call market breadth.
Okay, explain market breadth for listeners who might not know that term.
Sure. Market breadth basically measures how widespread the market's gains or losses are. Are lots of stocks going up or just a few big ones?
So good breadth means lots of stocks participating.
Exactly. If just a few very large stocks, like Apple yesterday, are pulling the index up while most other stocks are falling or struggling, that's poor breadth.
And what does poor breadth suggest?
It suggests the underlying health of the market isn't as strong, isn't as widely supported as those headline numbers might make you believe. It often signals a kind of foundational weakness beneath the surface. like a rally built on a very thin base, not broad optimism.
And this is where it gets really insightful for you, the listener,
Mhm.
because this dynamic, this narrow rally, heavily reliant on just a few key players.
It suggests investor sentiment is increasingly fragile and dependent. That's the quote from one analysis. Dependent on the performance of just a few dominant companies.
So it paints a picture of potential risk.
Absolutely. Imagine if one of these giants, let's stick with Apple, imagine if it stumbled, maybe missed earnings, faced some regulatory issue, anything.
Given their huge weight in the index.
Right. Their outsized influence means a fall could exert an outsized negative influence on the entire index. It could potentially wipe out gains elsewhere and drag everything down.
So for you listening, this means if your portfolio is benchmarked against the S&P 500, or maybe you just hold broad market ETFs.
You might actually be taking on far more concentrated risk than you realize.
You think you're diversified across 500 companies?
But in reality, a huge chunk of your performance is tied to the fate of just a handful of tech behemoths.
And this isn't just academic theory.
No. It has very real implications for how you build your portfolio, how you manage risk, and how you understand what's actually driving your returns.
It's a critical takeaway. You need to be well informed about your own exposure, not just the market headline.
U.S. markets. A tug of war between micro and macro forces.
So yesterday's session was just a prime example of this distinct tug of war, almost like a battlefield between competing forces.
Okay, lay out the two sides.
On one side, you had genuinely positive micro-level corporate stuff, strong fundamentals, companies reporting really good earnings, beating expectations.
The company-specific good news.
Exactly. But on the other side, you face these challenging macro-level headwinds, particularly new U.S. trade policy concerns and these lingering questions about the overall health of the U.S. economy.
It felt like two giant forces pulling in opposite directions, created a lot of tension.
That's precisely what our sources highlight, the central conflict of the day. One key driver lifting specific stocks was absolutely that flurry of strong Q2 earnings reports.
Like who? Any examples jump out?
Oh yeah. Companies like Grocery Outlet, Zeta Global, they weren't just beating estimates, they were raising future guidance, signaling real operational strength, positive outlooks. The market definitely rewarded that fundamental performance.
But that wasn't the whole story.
Not even close. This positive micro news was constantly being offset by significant, even escalating geopolitical developments.
Primarily the trade stuff.
Most notably, yes. The White House announcing new tariffs on India and threatening further protectionist measures targeting key global industries. That sent ripples of uncertainty everywhere.
So you've got individual companies doing great, but this huge cloud of political and economic uncertainty hanging over everything.
Massive uncertainty. Almost unprecedented, some analysts are saying, putting intense pressure on the broader market.
Okay, and this is the part that feels counterintuitive, maybe hard for listeners to grasp. How could the market absorb undeniably negative news, like new tariffs, and still manage to focus on earnings enough to close higher? It feels weird.
It does feel weird, and it raises a really important question. It's where we see the emergence of what analysts are increasingly calling a bad news is good news environment.
Explain that paradox. How does bad news become good news?
Okay, so alongside those geopolitical tensions, there's been this concurrent, pretty substantial shift in what the market expects the Federal Reserve to do about interest rates, monetary policy expectations.
Because of recent economic data.
Exactly. Weaker than expected data from the prior week. Specifically, that disappointing jobs report and another report showing the services sector is slowing down.
So weak data makes the Fed more likely to cut rates.
Precisely. It substantially increased the perceived likelihood of an interest rate cut by the Fed. To put a number on it, the CME FedWatch tool, which basically tracks market expectations.
Yeah, I follow that.
It now shows an 87.2% probability of a rate cut at the September Fed meeting. That's huge.
87%? Wow.
And futures markets are even pricing in 2 or 3 cuts, like 25 basis point cuts each by the end of 2025. A basis point is just 0.01%, for clarity.
Okay, so the market sees weak data and thinks, great, the Fed's going to step in.
That's the dynamic. In this peculiar environment, weaker economic data gets interpreted as a bullish catalyst because it pushes the Fed closer to easing policy, cutting rates.
And why is that good for stocks again? Remind us.
Well, more accommodative policy, lower interest rates, provides a crucial supportive floor for equity valuations, makes it cheaper for companies to borrow and invest. potentially boosting profits.
Right. And future earnings look better, too.
Exactly. Future earning streams become more valuable when you discount them back to today's dollars using a lower interest rate. It makes stocks look intrinsically more attractive.
So this expectation of Fed help allows the good company news to shine through.
It allows that positive micro-level news, like strong earnings, to have a much more pronounced upward effect. It cushions the blow from what would otherwise be pretty devastating macro news.
It's like the market's almost begging for the Fed to step in.
You could definitely interpret it that way.
Okay, this brings us right to the individual stocks, because the performance yesterday was just wildly divergent, a stark reflection of this tug of war.
Absolutely. Our sources show individual stock performance was almost entirely driven by Q2 earnings releases and, crucially, the forward-looking guidance companies gave.
And the market reaction was decisive.
Ruthless is the word I'd use. An absolutely clear pattern. Handsome rewards for companies that beat expectations and gave strong outlooks. Severe punishment, and I mean severe for those that fell short or signaled any future weakness.
No middle ground.
None whatsoever. Mediocrity was punished.
Okay, let's dig into some key gainers from yesterday. See this earnings dynamic in action. We'll pick a few that really illustrate these themes.
Sounds good.
First up, Grocery Outlet Holding Corp, GICO. It soared. Get this, 44.30%.
Incredible jump. 44%.
What drove that?
This discount grocery chain absolutely crushed its Q2 earnings per share estimates. And critically, they raised their full-year profit forecast.
So not just a slight beat, a real signal.
A genuine turnaround signal in their fundamentals. It shows they're navigating inflation effectively by offering value, which is clearly resonating with consumers looking for affordability right now.
Makes sense. Okay, next. Astrolabs, Inc., ALA, climbed 28.32%.
Yeah, this is a classic example of that AI purity rally we need to talk more about. Pure play AI infrastructure.
What do they report?
Significant Q2 earnings and revenue beat. Remarkably strong Q3 guidance. Why? Insatiable demand for AI infrastructure. Specifically, their connectivity solutions vital for high-performance computing and data centers.
So they're like the plumbing for AI.
Kind of, yeah. They showed how critical they are to that foundational layer of AI development.
Got it. Okay, a big one. Shopify Inc., SHOP, surged 21.33%.
Big move for them. E-commerce platform, better than expected results, strong guidance.
What was particularly important there?
Well, the feared tariff impacts. Analysts worried tariffs might squeeze their merchants, slow down cross-border trade. That just didn't seem to materialize in their report, or at least not nearly as badly as feared.
So relief drove the rally.
Huge sigh of relief for investors, gave them confidence in Shopify's resilience.
Okay, and finally, let's revisit Apple Inc., AAPL, up a significant 5.1%.
Yeah, as we mentioned. This wasn't primarily an earnings story for them yesterday, though their fundamentals are always in the background.
This was the manufacturing announcement.
Directly tied to that White House announcement, an additional $100 billion investment in U.S. manufacturing.
That's more than just Apple's bottom line, right?
Oh, absolutely. It's a massive commitment to U.S. economic activity, jobs. It's a significant political endorsement, essentially. And that resonated strongly with investors yesterday. Shows how macro-political decisions can directly juice mega-cap valuation.
Okay, powerful examples on the upside. Now let's flip the coin.
Let's look at the losers, because the market reaction to misses, or even just disappointing beats, was swift and brutal. Highlights that lack of mercy you mentioned.
Who got hit hard?
Consider Lantheus Holdings, Inc., LNTH, plunged a staggering 29.83%.
Wow, almost a third of its value. Why?
They didn't just miss Q2 estimates. They significantly cut their full-year guidance.
What reasons did they give?
Cited increased competition in their diagnostic imaging market, and also unexpected headwinds from healthcare payers on reimbursement.
So a negative outlook shift plus competitive pressure.
Exactly. Shows how quickly that can destroy shareholder value.
Okay, who else?
Six Flags Entertainment, FUN, dropped 21.44%.
The theme park operator, what happened there?
Their Q2 results fell significantly short of expectations. They also lowered their full-year outlook.
Ouch. Hopes for a big summer rebound dashed.
Seems so. It really spooked investors. And their commentary directly cited a challenged consumer environment. That's a crucial counterpoint to some of the more optimistic consumer stories out there.
Interesting contrast. What about tech losers?
Yeah, Supermicro Inc., SMCI, declined 18.32%. This one's fascinating because they're tied to AI, but they still dropped.
Why, if AI is so hot?
Weaker than expected results and guidance. Specifically, they cited higher costs from tariffs, There's that direct macro impact again, and also customer specification changes. Suggest maybe some tightening in their supply chain or demand dynamics.
So even AI-adjacent companies aren't immune.
Not immune to broader economic pressures. And it shows the market has incredibly high, maybe even unsustainable, expectations for this whole sector.
One more big name.
Advanced Micro Devices, Inc., AMD, fell 6.61%. Now, this is interesting because they actually had strong results and generally positive guidance.
So why did they fall?
Because their data center growth, which was 14%,
That's pretty good.
in any normal year, fantastic. But it disappointed investors comparing it to their rival NVIDIA, which posted like 73% data center growth.
73%. Okay, that puts 14% in perspective.
It perfectly illustrates the stratospheric expectations in AI-related tech. Even good results aren't good enough if they don't meet these almost fantastical projections. It's a market deeply focused on just a few perceived AI winners.
Sectoral splits, AI, policy, and the K-shaped consumer.
That detailed look at the winners and losers really drives home the point. Yesterday was a deeply divided market.
Absolutely split down the middle in some ways.
And when you look at the sectors, the 11 S&P 500 sectors, performance varied hugely.
Profound bifurcation, as our sources called it, underscores a highly selective investment environment.
So definitely not a rising tide lifting all boats.
No, it was about specific boats getting a massive, almost singular lift, while others just struggled or sank. Shows a very discerning flow of capital.
And the main theme driving that flow seems to be...
Well, the prevailing dynamic can really be summed up as AI versus everything else.
Okay.
Information technology was the strongest sector, up 1.12% on the day, impressive, plus 13.42% year-to-date. But even that strength wasn't uniform.
Not all tech stocks did well, as we saw with AMD and SMCI.
Exactly. It was almost exclusively driven by what we're calling a flight to quality and growth within the artificial intelligence ecosystem. Not just any tech company rallied. It was a targeted surge into companies seen as the foundational enablers of AI.
The AI purity rally you mentioned.
That's it. Companies directly enabling AI infrastructure, like Astra Labs we discussed, saw explosive gains. They're seen as the indispensable picks and shovels in the AI gold rush.
Providing the core components.
Right. But at the same time, other established tech firms like AMD and Supermicro got heavily penalized, even with decent results, just for failing to meet those stratospheric expectations for AI growth.
Like AMD's 14% data center growth not being enough.
Precisely. It shows this is not a broad tech rally like the dot-com boom. It's highly discerning, hyper-focused. Capital is concentrating in a few perceived winners.
What are the risks of that concentration?
Well, it increases systemic risk within the sector. And for you, the investor, it could create significant value traps.
How so?
If you're just chasing the technology theme broadly without understanding the nuances, who's really enabling AI versus who's just benefiting tangentially, you could get caught. You need to differentiate.
Okay, so with capital pouring so selectively into AI, what does this mean for other parts of the economy? The sector's not directly tied to chips and algorithms.
Right. Let's look at the underperformers. This is where macro policy really started to bite hard yesterday.
Like healthcare.
Healthcare was the day's worst performer, down 1.42%. And it's the biggest laggard year-to-date, down over 5%.
Why such pressure on healthcare?
It's a direct consequence of policy uncertainty, that cloud hanging over the industry. President Trump's repeated threats to impose broad tariffs on imported pharmaceuticals. That's a huge overhang.
Affects their supply chains, costs.
Absolutely. Impacts drug manufacturers, distributors, and this external risk is compounded by domestic concerns, potential changes to government reimbursement policies, other measures to lower drug costs.
So politics is really weighing on the sector.
It vividly demonstrates how political rhetoric and policy threats, even before they're fully implemented, can hammer entire sectors, regardless of individual company performance.
Okay, what about energy? Also down yesterday, about 1%. That seems weird given Middle East tensions.
It does seem counterintuitive, right? You've got heightened geopolitical tensions involving Iran, which usually adds a risk premium to oil prices. More instability normally means higher oil due to supply concerns.
But that's not what happened.
Nope. West Texas Intermediate WTI crude futures, the U.S. benchmark, were actually lower yesterday, trading around $65 a barrel.
So why were oil prices down despite the risks?
It indicates that fears of demand destruction.
Meaning less demand for oil.
Yeah, fears that a potential global economic slowdown will hurt demand for oil. Those fears are currently outweighing the supply-side risks from the geopolitical conflict.
So the market's more worried about recession than war disrupting supply.
In essence, yes. The thinking is, even if supply gets tight, if people aren't traveling, factories aren't running full tilt, economic activity slows, demand will fall even more, pushing prices down.
Wow, a complex balancing act.
Very complex. And right now, concern for economic health is winning out over supply fears.
Okay, let's shift to the consumer. We saw something really interesting. Both consumer discretionary, plus 1.97%, and consumer staples, plus 1.60%, were strong.
Both up nicely, yeah.
But how do we reconcile that broad strength with all the mixed signals about consumer health? Seems contradictory.
This brings us right to the idea of the K-shaped consumer. That metaphor seems increasingly accurate,
K-shaped meaning.
meaning diverging paths. The strong performance in those sectors wasn't a sign of uniform consumer health. It was driven by very specific earnings reports.
Like who?
Like McDonald's beating estimates, largely because their value promotions are working, shows consumers prioritizing affordability.
Okay, value focus.
And then Uber CEO reported seeing no signs of consumer weakness, maybe suggesting resilience in services or among higher income consumers using convenience apps.
But that contrasts sharply with
Six Flags,
Right.
which, as we noted, cited a challenged consumer and falling attendance, especially among lower income families feeling the pinch.
So it's not one single consumer story.
No. This divergence points to a nuanced K-shaped spending environment. Some segments, typically higher income, less inflation-impacted folks, are doing okay, still spending on certain services or goods.
While others are pulling back?
Exactly. Lower to middle income households are clearly prioritizing essentials, value, convenience, opting for fast food deals over theme park tickets or other deferrable purchases.
So a highly selective consumer.
Very selective. Purchasing power and willingness to spend are diverging sharply. For you, the investor, this means broad bets on the consumer are risky. You need to know which consumer a company targets. What's their income bracket? What's the value proposition? Stock selection within these sectors is critical.
Global ripples. Trade wars and geopolitical chess.
Okay, beyond earnings and sectors, yesterday's trading was just heavily influenced by this turbulent geopolitical backdrop, right? With U.S. trade policy as a primary catalyst.
Absolutely. You simply cannot understand yesterday's market without looking at these global ripples that chess moves on the international stage.
And the biggest move yesterday was
Arguably, the tariff front. That was the most significant policy development with immediate global impact. President Trump issued an executive order slapping an additional 25% tariff on imports from India.
additional 25% on top of existing tariffs.
Correct. This new levy, kicking in August 27th, brings the total tariff rate on most Indian goods to a whopping 50%. 50%.
Why? What was the stated reason?
The administration explicitly cited India's continued purchase of Russian oil as a threat to U.S. national security.
So using trade policy as a foreign policy tool.
Clearly. And our sources emphasize this marks a significant evolution in the administration's trade strategy.
How so?
Tariffs are no longer just being positioned as tools to fix trade imbalances or protect U.S. industries. They're now being explicitly and strategically weaponized to achieve broader geopolitical goals. In this case, pressuring India on its energy choices.
Wow, that adds a whole new layer of complexity for global business.
Dramatically increases complexity and uncertainty. Companies now have to evaluate not just economic policies, but also the geopolitical alignments of their trading partners.
It's a new, unpredictable risk layer.
Totally. Imagine you're a textile company relying on Indian cotton, or a pharma firm sourcing ingredients from India, suddenly facing a 50% cost increase.
You'd have to rethink everything. Supply chains, pricing.
Rapidly reevaluate your entire supply chain. Maybe expensive reshoring, maybe diversifying to other countries. It makes long-term planning incredibly difficult.
So global businesses are navigating this expanding minefield now, where political allegiance matters as much as cost.
They absolutely are. Risk assessment becomes much more complex. It's not just about cost efficiency or speed anymore.
It's about geopolitical resilience.
Increasingly, yes. Avoiding punitive measures. Supply chains built on pure economics might need rapid redesign based on political factors.
Which could mean higher costs for everyone eventually.
Could lead to higher production costs, longer delivery times, less overall efficiency. But it's the new reality they have to deal with, balancing economic logic with political calculus. A very tough tightrope walk.
And as if trade wars weren't enough, the Middle East tensions are still simmering.
Still there in the background, absolutely. Our sources remind us the situation is fragile after those recent U.S. and Israeli strikes on Iranian nuclear facilities.
There's a temporary ceasefire, apparently,
Purportedly, yes, reducing the immediate risk of a massive oil supply disruption. But the potential for escalation is still a key concern for investors.
including the risk to the Strait of Hormuz.
Always. That critical choke point for global oil shipments, a closure there would be huge. We saw how this feeds into oil price volatility that push and pull where demand fears currently outweigh supply risks.
But that balance could flip quickly.
Very quickly if things escalate again.
Okay, let's take a quick snapshot. How did international markets react to all this yesterday?
It was mixed but largely resilient, interestingly, though you could see specific pockets of vulnerability directly tied to U.S. policy announcements.
What about Europe?
Major European markets finished mostly positive. Germany's DAX up 0.25%, France's CAC 40 up 0.22%. The UK's FTSE 100 actually hit a new closing high, up 0.24%.
So Europe held up okay.
Well, the broader pan-European StoXX 600 was almost flat, down just 0.04%, so momentum wasn't universal. And the session was heavily influenced by U.S. tariff talk.
Specifically hitting which sector?
The StoXX healthcare index fell to a 4-month low after Trump's threats against pharma imports, a very direct, immediate policy impact rippling across the globe.
And Asia, what was the picture there?
Also quite mixed, but with notable strength in Japan and China, showing different dynamics.
Japan was up.
Yeah, Japan's Nikkei 225 climbed 0.60%. Automakers gained there, seemingly on optimism about getting favorable terms in trade talks with the U.S., suggests maybe some specific deals are expected despite the broader threats.
Interesting. And China?
China's Shanghai Composite rose 0.45%. There were reports of increasing foreign investor interest in Chinese assets, which is significant in itself. Suggests capital is still flowing there despite tensions.
And elsewhere?
Australia's ASX 200 hit a record high, helped by strong commodity prices, but markets in Hong Kong and Singapore were down. Again, illustrates that varied, selective performance globally. Local factors and specific trade relationships are playing a huge role. Outro.
Okay, as we wrap up this deep dive, it is abundantly clear yesterday was anything but straightforward. That headline calm, truly deceptive, masking some profound shifts underneath.
Definitely a lot more going on than the closing numbers suggested.
So looking ahead, what should we as informed observers be watching for tomorrow, Thursday, August 7th? What will keep shaping these market dynamics?
Okay, for tomorrow, several key things are on the radar, likely to influence direction. First, over in the UK, the Bank of England announces its monetary policy decision.
A rate cut is expected there, right?
Widely anticipated. 25 basis point cut, 0.25%. But the market reaction will hinge not just on the cut itself.
What else matters?
The vote split among the policymakers shows how unified they are, and, critically, the forward-looking guidance in their monetary policy report. Their commentary on future rates could really set the tone for global central banks and currencies.
Okay, Bank of England decision. What about the U.S.?
Several economic data points do. Preliminary Q2 productivity figures gives insight into economic efficiency. Final June wholesale inventory signals future demand. And June consumer credit data looks at household debt.
Anything else? Fed speakers?
Yes, perhaps more importantly, several Fed officials are scheduled to speak. Their commentary will be closely parsed, as the reports say.
Looking for hints on U.S. rate cuts.
Exactly. Remember that bad news is good news, dynamic. Their words will be weighed incredibly carefully for any shift in tone, any hint of more dovishness.
And earnings season isn't over yet.
Nope. Notable reports expected after the close today, August 6th, which will hit tomorrow's trading. Think Airbnb, DoorDash, giving us fresh reads on travel and delivery sectors.
Okay, so synthesizing all that, what are the key overarching themes to keep watching tomorrow and beyond?
Right, 3 main things stand out. First, continued tariff fallout. Markets will keep digesting those new India tariffs. And August 7th is actually the effective date for many earlier reciprocal tariffs.
Could trigger fresh volatility.
Could do, yeah. As businesses start feeling the direct financial pain, especially those with complex global supply chains. Watch the exposed sectors.
Okay, tariff fallout. Second theme.
Central bank divergence. The Bank of England's expected cut stands in stark contrast to the Fed's more patient, data-dependent stance right now.
Different paths for major central banks.
Highlights that growing divergence. It impacts currencies, capital flows, economic competitiveness, key indicator of where global growth and inflation expectations are heading.
Makes sense. And the third theme.
Keep a close eye on market internals. The big question. Can the rally finally broaden beyond that small, concentrated group of negacaps that led yesterday?
Will other stocks join the party? Mid caps, small caps, other sectors?
Exactly. If it fails to broaden, if we keep relying on just a few big players, it reinforces those concerns about sustainability, about the fragility of market breadth. Suggests a precarious market leadership.
Okay, so putting it all together, what's the strategic outlook based on our sources?
The clear picture is this: a significant disconnect. You've got strong, bottom-up corporate earnings on one side.
Companies doing well individually.
Right. But on the other side, a deteriorating top-down macroeconomic and geopolitical landscape.
Creating a difficult environment.
Creates a highly volatile, headline-driven trading environment, where fundamental analysis looking at company profits, balance sheets has to be supplemented, maybe even overshadowed sometimes, by a keen awareness of political and policy risk.
So nimble strategies are favored.
Prevailing conditions strongly favor nimble, active strategies over passive long-term approaches that might be more vulnerable to sudden shocks. Buy and hold might be tougher right now. Understanding macro currents is crucial.
And expect more volatility.
Project continued volatility, yes. Market direction likely dictated by the Bank of England tomorrow, and any further U.S. trade or foreign policy news, especially those weaponized tariffs.
Okay, let's leave our listeners with a final thought. If we connect all this to the bigger picture.
Yeah.
Given everything we've unpacked today, the deceptive calm, the narrow rallies, the geopolitical chess, the K-shaped consumer, the central bank dance, what does this all tell us about where true value and true risk lie in this interconnected yet increasingly fractured global economy?
That's the million-dollar question, isn't it?
Maybe something for you to consider. How might these huge macro forces keep shaping not just big investment decisions, but even the details of daily economic life for businesses and individuals everywhere?
A lot to chew on.
It is. We'll be here to deep dive into it all with you next time.